Well, speaking of mortgage rates, of course, they're tied to benchmark interest rates. And investors are looking closely at Fed comments this week for views on the latest economic data and the policy outlook following last Friday's surprisingly strong inflation report, that PCE report. Here to discuss this and more is Gibson Smith, Smith's Capital Investors founder and chief investment officer. Gibson, thank you for being here. I just mentioned the pending home sales that we got. We got PCE on Friday showing some heat is still there in inflation. What does all of this mean for the interest rate outlook in your view?
Well, it's been just a fascinating year to date, where we've seen rates rally and stocks rally really hard in January and then completely reverse course in February. And I think what's playing out here is the market is and was getting in front of the Fed in this view that their aggressiveness over the last 12, 13 months would ultimately lead to a slowing of the economy, and therefore they would pause and ultimately start easing, out on the future. What that did was loosen financial conditions, which is setting us up for what you're talking about, which is maybe a reacceleration of the economy or things getting better. It's probably one of our concerns around rates, in that as the economy does better, rates could move higher. I think the most important element, though, is when we look at that core PCE number, it was a surprise, very similar to the non-farm payroll number that we saw at the beginning of the month. And it puts the Fed in a really difficult position.
So what type of landing are you anticipating? And have we overdone this analogy?
I think so. It's soft landing, hard landing, no landing. We keep hearing about these expectations, but the reality is that we are on a lower growth trajectory going forward. And the Fed is trying to engineer a slower growth outcome for the economy to take care of the inflation problems that we're dealing with. So, hard landing, soft landing, I really don't want to get caught in the definitional terms of how we get there. What I view as critically important is the more aggressive the Fed has to be around fighting inflation, the greater the risk of a hard landing or a much greater slowdown in the economic outlook and the economy.
So we've been talking throughout the show and really throughout the past few days, the conversation around volatility has really been ticking up, that people are buying more protection in this market, perhaps because they're worried about some of the stuff you're talking about. What does protection look like for you right now? Is that the sort of tack you're taking?
Well, I think protection in general is a defensive positioning in our portfolios, making sure that we have a lot of dry powder to take advantage of that volatility, but also not expressing really strong opinions or views. And when we look at the market, there are a lot of things that could go really right. There are a lot of things that could go really wrong. And when you're at these inflection points, you do get these heightened levels of volatility. I mean, just look at January and February in terms of what we've seen. I mean, a 65 basis point rally in the 10-year Treasury and then a 55 basis point backup. I mean, that's real volatility for investors to contend with. So I think defensive positioning, being very tactical, being very nimble in the market, and then taking advantage of that volatility. Again, I can't stress this enough. I think the Fed has to remain vigilant on inflation. And the more aggressive they are in fighting inflation, the greater the risk of a slower economy in front of us.
So what does that signal to you in terms of how the companies, the sectors that had performed well in the previous bull market will perform even as the Fed continues on its own policy pathway?
Well, great companies do well through good times and bad times. What we really have to watch are the companies that were misallocating capital, taking on too much leverage, getting in front of their skis and this expectation of a much stronger growth outlook. Those are the companies that are going to be vulnerable. And we've seen a lot of that mispricing, or we saw a lot of that mispricing in 2022. Now we're going to really separate the really great companies from just the average companies and the bad companies. And I would anticipate that as we get into the next round of earnings, we're going to see some real surprises as the market continues to adjust for a much lower earnings outlook. And, when you've got a slower economy, it's really hard to drive great top line growth when the overall economy is just kind of muddling along. And so I think we're going to see a much more volatility on the horizon, and we're going to see massive differentiation in valuations in the equity markets and in the credit markets.
So how do you find the companies that are going to do better in this environment? What sort of criteria are you looking for?
Well, you look for durability and resiliency. I mean, companies who have started preparing for a slower growth environment, we see it all around us. Companies are reducing headcount. They're focusing on costs. They're really paying close attention to their margin structure. And those are the companies that will weather a slower growth environment better than others that are not doing those proactive activities within their business. And when it really comes down to it, you have to look at the margin structure of a business and determine the resiliency of that margin structure. And there are plenty of great companies out there that are going to do well in a slower growth environment, and then there are others that are not. And our job as bottom-up fundamentalists, researching companies, one company at a time, is to seek out those companies that are, again, very resilient and prepared for more difficult times in front of us.
Gotcha. Gibson, thanks for joining us. Gibson Smith, Smith Capital Investors founder and chief investment officer. Appreciate it.